Hello, welcome back. Here is Ali Talabi, and this is our lesson 5 from module 7. We are going to talk about the stocks. More specifically, I will talk about technical and fundamental analysis. I will provide you some brief information about technical analysis. The major focus of most of investment and finance courses, especially in the academia environment, is around fundamental. And also I will talk about the EMH, efficient market hypothesis, and I will wrap up with some insights toward behavioral finance and why it's kind of different than the traditional approach, which is based on EMH. Remember that most of investors, when they want just to trade, buy and sell, the major goal here is just to beat the market. It means they want just to outperform the market. So they want to get more than what other investors are making, so more than the average. So if, for example, you use the S&P 500 as the benchmark, you want just to beat the market, you want just to beat that index. That's the goal. So in the fundamental analysis, we mentioned our major goal here is just to find the true value, or what we call intrinsic value of a stock. And then you look at the market and you compare your intrinsic value with the market value to see whether it's kind of underpriced, overpriced, and based on that, you decide to buy or sell the stock. However, in technical analysis, you mainly look at the historical data, historical performance of the company based on the price, so you look at the price, you look at the volume of the stocks, and based on that, you try just to find or identify a specific patterns. So when you look at the stock prices, you want to see whether there is a specific patterns. And when I'm talking about the pattern, there are many different models which you can use just to see whether you can recognize a pattern. So you can use moving averages, you can use support resistance level. So there are several tools which we are using technical analysis. And again, our goal here is just to see whether you can find that point which gives you the selling signal or buying signal, and after that you go ahead and you make your decision. However, there's many research, many studies, they're indicating that in the market, the prices are moving randomly, so which is called random walk. So there is no predictable trend or pattern. So if you're just looking for the pattern, you might become disappointed because you cannot find that specific pattern. This kind of counter argument to what technical analysts or chartists are arguing. So again, they're looking, the technical analysts, the chartists are looking for some signals from the market, and these signals might be bullish, positive, or bearish, negative signals, and they look at the stock prices to find this. The major job of the chartists, as I mentioned here, is just to find the next move of the stock. So they want to see where the stock is heading to, where the market is heading to. Because if you know the next move will be up, so you can buy. If you know the next move is down, you are going to sell. So this is kind of different than the fundamental analysis perspective. In the fundamentalists, actually they're not looking for the pattern, just to look at some essential indicators which is showing the performance of the company. The company is performing well or not well, and based on the company's performance, what should be the stock price. So there is no, when it comes to fundamental analysis, you're using some valuation techniques. When it comes to technical analysis, you are not actually using any valuation technique just to find the value of the company. To be honest, you don't care in technical analysis that the company is overpriced or underpriced. Again, you are just considering the pattern. If the pattern is saying the price is going up, even though the fundamental analysis maybe it's telling you that the stock is overpriced, you will go ahead and you will buy it. Now, it was around 1970s that some actually scholars, including Eugene Fama, they came with the idea of efficient market. So they noticed that the prices are moving on random direction, and it seems there is no specific pattern in the market. So these scholars came with the efficient market hypothesis, and they argued that the market is actually reflecting all available information. In other words, that's the term we use in the world of investment. There is no free lunch. So the prices are moving randomly. The information is already reflected in the prices. So you cannot benefit from the market. You cannot take advantage of the market. You cannot beat the market if you are using some historical information, if you're using publicly available information. And this is, as I mentioned, it's called EMH, or efficient market hypothesis, and that's a major argument. The prices reflect all available information. There is no free lunches, so you cannot beat the market just based on public information, historical information. However, in terms of the efficiency, the scholars came with 3 different levels of efficiency. And they said, you know what, different markets, they might be efficient in 3 different levels. So the first level, it's called weak form of efficiency. So in the first level, which is called weak form of efficiency, just historical data are reflected on the price. So let's call this weak form. And as I mentioned, the weak form, just historical data are reflected in the price. So you cannot use the volume of transaction, the historical price, or any data which is available based on the historical data just to actually beat the market. The second level, which is called semi-strong form of efficiency, the argument here is not only the prices are reflecting the historical data, but all public available data are reflected in the prices. So here it was historical, here is just public available data. What's the difference? Public, it might be some information regarding the future of the company. For example, the company is going to launch a new branch, or it's going to launch a new product. So this is type of the public information. So if we are in the semi-strong form of efficiency, the historical data, the public data are reflected in the stock price. So you cannot use those information to beat the market. In the highest level of efficiency, which is called a strong form of efficiency, not only we have historical data reflected in the price, not only we have public data, but also private data are reflected in the stock prices. For example, if you are the CEO of the company, so you are a kind of insider, you cannot even beat your own company, your own company's stock. So you cannot go ahead and outperform the market based on the information you have from your own company. So this is the highest level, a strong form of efficiency. So we talk about technical analysis, and I mentioned that most of chartists or technical analysts, they're using historical data like volume of transaction, like the stock prices, moving average, and several tools which are based on either volume or the price. Now, if you believe actually in even the weak form of efficiency, you shouldn't do the technical analysis, because we mentioned the weak form of efficiency, the historical data are reflected in the price. So if you have that information, anyone else has that information, so you cannot beat the market. However, if you don't believe in efficiency, even the weak form, maybe you should consider using technical analysis. So the counter argument here is that the market is not as efficient as we thought it is. So there are many scholars, there are many research, many studies which they provide evidence of something which is called anomalies, like January effect, week of the year effect, months of the year effect, day of the week effect, bubbles, crashes. All these are anomalies which are indicating that, you know what, there might be some other factors than the rational behavior of investors, because the rationality of investors, because the efficiency of the market cannot explain these phenomena. So I highly encourage you to watch these 2 videos. The first one is regarding the EMH, in which Fama is explaining the EMH and saying what does it mean. And the counter argument here is what Robert Shiller is providing on efficient market theory, and is saying, this excessive volatility we see in the market, it doesn't indicate the rational behavior of investors. So it seems this, actually in his great book, Rational Exuberance, he's talking about all these over transactions and over volatility in the market, which the rational behavior of investors cannot explain this extra or excessive volatility in the market. So I'll encourage you to watch these videos. I provide the links in the description to these videos. They're just a few minutes, and spend your time, and you can see two different arguments. One, EMH, the other is more behavioral finance, and how they are comparable. So I talk about the counter argument to EMH, which is called behavioral finance. So when we talk about the behavioral finance, that's the area of research that tries just to understand and explain how reasoning errors influence investor decision and market prices. So in other words, sometimes we are making emotional decisions. We are making some decisions which we cannot justify with the rational behavior or rational reasoning. So all these biases or errors prevent us to make the kind of rational decision. So we need to consider those attributes, those errors when we are going to make a decision. And there are tons of actually behavioral biases, such as the overconfidence, anchoring, and many of them, which you can find, and you'll see that all of us as investors are affected by this decision. It is not just about investors, it is about human beings and how we are making some emotional decisions which are far away from rational decisions. Behavioral finance is mainly actually is based on the research in the area of cognitive psychology. So if you're interested, you see that actually the behavioral finance is not pure finance. It is more, it has its stems and roots actually in cognitive psychology. What is cognitive psychology? Just briefly tell you, that's a study of how investors actually think, reason, and make decisions. It is about the decision-making process. And as I mentioned, since we have reasoning errors and biases, which are called cognitive errors, this might impact in our decisions, and we end up making irrational decisions. So if, let's assume you have all these investors in the market which are making irrational decisions, and they are making these cognitive errors. In this case, you should expect some inefficiency in the market. So you can, which in this case, the EMH will be kind of violated, and it may not work in some cases. I mentioned there are several errors. One of the common one when it comes to behavioral finance and decision making is overconfidence. So most of investors, they believe they have some specific type of knowledge and they can beat the market or outperform the market. So this is a kind of sign or indicator of overconfidence. So again, it's not just about the investment. Most of people are kind of overconfident about their abilities in different areas. And for example, if I ask you, do you believe you are better than average driver? Most probably you say, yes, I'm much better than the average driver. So and based on the research, for example, over 80% of people, when they're asked this question, they will say, yes, I'm better than average driver. So if that's true, it cannot be true, because you cannot be 80% of people, they cannot be better than 50% of the drivers. So it's kind of contradictory. So that's the idea. Again, what is the result of this overconfidence from the investment perspective? If you're overconfident, remember we talk about irrational behavior. In this case, you might buy and sell stocks based on the knowledge you believe you have, but you don't have. So we might end up buying more than we should. So we are paying for transaction fees, and we are losing many opportunities, or we are actually selling at the time which we do that, which we shouldn't. And in this case, we are losing lots of money. So that's how it actually works. That's it for today. Thank you very much. So we'll wrap up our module 7. We look at some questions and some hints next lesson. So talk to you soon. Have a wonderful day. Here is Ali Talibi. Bye.